Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Sofi Technologies SOFI stock, and then we're going to be going over two other stocks that you all commented down below in our last video, which is going to be AST SpaceMobile as well as VALE S.A, and those are going to be the companies that we are going to be analyzing today. We're going to be going over all of their price targets, price predictions, news updates, as well as what I personally think of the stock, and we are also going to be analyzing various articles about these particular companies. If you don't know what these companies do, don't worry, I will explain that as well, and we're going to be going over if these are even good investments to invest into. So for more videos on Sofi Technologies or any other company that you all comment down below, remember to go and smash that like button right now, subscribe if you are new, comment down below some companies you want me to review, and without further ado, let's jump right into today's stories. So we're going to start off with Sofi Technologies, ticker symbol SOFI. Right now, the Sofi stock share price is trading at around $6.17 per share, while professionals believe the company is worth anywhere between $7 and $11 over the next 12 months. This company is a fintech company, or a financial technology company, that basically operates as a digital bank. They offer their consumers an all-in-one inclusive digital app where they can access anything they could probably or possibly need in terms of financial services and or financial products. This would include various types of loans, credit cards, debit cards, checking accounts, savings accounts, and a plethora of other investing tools to buy and sell stocks, cryptocurrencies, and other assets. Sofi Technologies is a very innovative fintech company, and so far this year, their stock price has dropped by around 61% due to three main reasons. And we need to understand these reasons so we can determine if right now is a good time to buy this company on a discounted basis. The first reason is that there was ambiguity regarding how the Biden administration was going to deal with student loans, regarding the student loan moratorium repayment and the student loan forgiveness. Now that we've actually seen a clear and cut plan for this, we have now less ambiguity surrounding Sofi Technologies, which should act as a fantastic catalyst in the beginning of 2023 when the student loan moratorium will be ended. The next problem was the fact of the overall market. We see very high inflation rates and increasing interest rates to get inflation under control, which is what the Federal Reserve is doing, and I think they are doing a pretty good job. This has then caused the third problem of investors liquidating their risky growth and technology stocks and invest into more value and dividend yielding stocks, which is honestly not too bad of a move. However, this has negatively impacted the fintech space as well as growth and technology companies, specifically growth and technology companies that have a lot of risk associated with them, which would include Sofi Technologies. However, recently, we've seen the ambiguity and more clarity in the market of this particular company and the overall macroeconomic projections. For instance, we know that the student loan payments are going to resume on January 1st of 2023, and therefore the student loan moratorium is going to end. So there is no ambiguity or uncertainty regarding what the Biden administration is doing with student loans, because we have clarity on that now. This adds a fantastic catalyst for companies like Sofi Technologies. The second problem that I think we have gotten clarity on is inflation as well as rising interest rates, where the Fed has come out and said that they are going to continuously increase interest rates until inflation comes under control. As for investors liquidating growth and technology stocks and investing more into value and dividend stocks, I actually don't think that's a very bad thing at all, because if you have a very well diversified portfolio, you should already be investing into those types of companies, blue chip companies, value companies, and dividend companies as well. So although your growth and technology stocks may be down, your other stocks should be up if you have a well-diversified portfolio. Now, because we have clarity on the three main drivers which caused the Sofi stock price to fall, we can now anticipate that the stock price could bottom out here around $5 or so and then start to appreciate in price. And we will talk about the minimum cost basis that you would want for this particular company. Also, I want to point out that Sofi is going to benefit heavily once the student loan moratorium ends, because it's going to increase volumes of people to actually refinance their student loans, which is going to attribute to their overall revenue growth, which is already fantastic. It's over 30%. So I would say, as well as this article says, that Sofi Technologies has fantastic catalysts laid ahead of it. I also want to say that in our last video, we talked about how a Bank of America securities analyst upgraded Sofi stock from a neutral rating to a buy rating, and and they increased their price target to $9. This sentiment and very bullish positive sentiment is reflected in what a Wedbush analyst said recently, who is very upbeat about SoFi's future growth trajectory. He says that student loan originations in 2023 are poised to rebound from depressed levels, and its bank charter should accelerate earnings growth, end quote. So overall, he says that from 2023 onward, we could see the SoFi stock price appreciate very aggressively, and that's what I'm currently waiting for. Like we said earlier, the current stock price is trading at around $6 per share, but the average analyst price target for this company is currently around $8.11, which would mean that investors have an average increase or an average upside of around 31.4%, which is absolutely phenomenal. This would beat the overall market by around almost 4 times if we're saying that the S&P 500 benchmark gives investors around an 8% increase per year, which it has historically brought in if we factor in inflation. So given these very positive signals, why am I very bullish on SoFi Technologies? And as a disclaimer, I currently hold around 4% of my portfolio in SoFi Technologies, so it's not like I'm super exposed to this company, but I do have around a 4% allocation, and I don't allocate more than 5% allocation to any individual company, because I believe that my portfolio should be made up of 20 or more companies that all have fantastic growth trajectories. Why would I just bet on one growth company when there are a plethora of various companies on the market that I would like to invest into, which lowers my chances of losing money while also preventing me from taking on unnecessary risk? But besides that, what other developments have we seen from SoFi? Well, over the past few months, we actually see smart money and hedge funds buy SoFi Technology stock. And what do I mean by this? Literally, hedge funds have bought up around 15.3 million shares of SoFi during the last 3 months. So clearly, smart money thinks this company is phenomenal. Also, I want to point out that TipRanks actually gives this company an outperform rating and a smart score of 9 out of 10, which means 10 is the best. So clearly, they think that SoFi Technologies is very likely to beat the overall market expectations and outperform the market in general, which is why I gravitate towards SoFi Technologies, because I think it is a good growth company that is really going to put the pedal to the metal in terms of their stock price appreciation from 2023 onward, especially when the company is projected to become profitable in 2024 or sooner. So I give this company an A+ rating if we are investing into risky growth stocks. But remember, there are risks for these companies. Now, the next 2 companies I'm going to talk about are companies that I personally don't really think are as good as SoFi Technologies, but I do want to give you the latest on them. I think these companies are very, very risky. However, they do have fantastic growth potential, particularly when we talk about AST SpaceMobile, ticker symbol ASTS. Analysts believe this company could surge, jumping from $10 to $30 in the next 12 months. Now, I personally don't think this company is going to pull those numbers this quickly. However, this is up for you to decide, and I would always recommend you do your own research on these companies before you decide to invest into any asset. If you didn't know, this company was a former SPAC company which joined and acquired Providence Acquisition Corp. And right now they are building a space-based cellular broadband network. And I think this company does have very good prospects to it, but I really want to wait for this company to prove itself before I invest into this particular company. AST SpaceMobile, ticker symbol ASTS, has successfully launched and placed their Blue Walker 3 test satellite into orbit after many months of preparation, which is why the stock price surged by around 6.3% in the pre-market. However, I anticipate that this catalyst and the overall stock price will eventually cool back off. Now, this is very bullish and a good sign for this company because they are clearly launching satellites into space, which is helping the overall company fundamentals, which is aligning very well with the company's business plan. The company plans to actually provide direct satellite communications to non-specialty and commonly unavailable wireless handsets, which I think is a very good goal. The chief strategy officer says that the Blue Walker 3, which is their satellite, is on course and securely circling the Earth. He goes on to say the satellite satellite is thermally stable and communicating directly with ground stations. So clearly this was a huge success on the company's part. I also want to say that this company has very impressive intellectual property, or IP. But why do I say that? The company has around 2,400 or 2,400 patents or outstanding patent claims, which supports its overall space-based cellular broadband approach. And this means that other broadband companies and businesses will not be able to infringe or steal these particular ideas or their technology because they have already patented or are in the process of patenting this. I also want to say that they are working and have multiple contracts and agreements with around 25 mobile network operators who collectively serve around 1.8 billion subscribers. This would include very impressive companies such as American Tower as well as AT&T. So clearly this company is being used by very large businesses. The chairman and CEO even said, and I quote, "A major achievement in our mission to connect the unconnected has been accomplished. We are working hard to ensure that no one becomes a second-class citizen regardless of where they live or work because of their lack of access to cellular broadband," end quote. And I think that this is a very good prospect and a very good goal to have for this company. They want to bring broadband to everyone regardless of where they live because they think everyone deserves access to this technology, and I 100% agree with them. The company is currently preparing for an assembly and production of their next phase of satellite, which is going to be their Bluebirds, and they plan to do that in Texas. So although this company has a very good trajectory, I just am waiting for the company to prove itself before I am comfortable saying that this company is going to surge by 300%, which is what multiple analysts believe. However, there is a caveat to that because currently only 2 professionals review the company as of right now, so it's not like we have a lot of analysts or professionals to choose from. We have a very low amount of analysts who are not overly impressive analysts, so we should take this with a giant grain of salt. So I personally will not invest into this company until much later if the company decides to prove itself. Now, the last company we're going to talk about was another comment on the last video, and that is VALE, ticker symbol VALE, which currently trades at $12.92 per share, while professionals believe the company is worth anywhere between $12 and $25 over the next 12 months. This company is a Brazilian-based metal and mining company which is primarily engaged in obtaining iron ore and nickel. However, the company also tends to stumble upon various other metals such as iron, platinum, gold, silver, and cobalt. And many electric vehicle companies actually use this company to get these various materials from so they can end up making their batteries. Shares of this company have lost around 3.17% over the last month, which is actually not bad because the overall S&P 500, which is a stock market benchmark, has lost around 7.95%, so clearly this company is less volatile than the overall market. However, with that being said, I am still not a believer in this company. I do have some exposure to this company, but that's only to stabilize my portfolio because this company is clearly not a growth company, and I don't expect this to build a large amount of wealth for consumers. However, it does have very stable stock price appreciation, and it holds its value very well, which is one of my catch stocks, or stocks that I use so my portfolio doesn't lose a lot of money during times of stock market uncertainty or a market crash. VALE also is set to have a pretty disappointing next quarter earnings report because analysts currently project that they're supposed to bring in around 83 cents per share on the positive side, which would equate to around a 28.45% decline in their earnings. We also have a consensus estimate for their quarterly revenue where they're anticipated and projected to bring in around $12.83 billion, which is actually an increase of 1.13% from a year ago. For the entire year, Zacks estimates for this company says that they are supposed to bring in $3.21 per share for their earnings, and their revenue is anticipated to come in at $48.11 billion, which would equate to changes of a loss of around 40% and a loss of around 12 to 13% respectively. So honestly, I don't think it's going to be a very good year for this company in particular. However, I do want to say that this company is a market leader and they are very competitive in their respected space. Like I said earlier, I do own this company. I have some exposure exposure, but not even 2% of my portfolio is made of this company. I do like this company because of its ability to hold its stock price. And that's another reason why Zacks Rank actually says that this is a holding opportunity to buy and hold this stock, mainly because it has pretty impressive accounting ratios. For instance, if we look at their PE ratio, which is their price to earnings ratio, it's hovering at around a 4.1 right now. But why is this good? Well, it's good because the industry average currently has a PE ratio of 6.07, and ideally, when we're talking about PE ratio, we want that to be rather low, particularly below their overall industry average, which means that this company is trading at a discount comparatively or compared to the other companies or their overall industry, which I find pretty bullish. However, over the next year, this company is supposed to get hit pretty hard in terms of their overall revenues as well as their earnings. If anything, I would hold this company for the short term, or I would wait an entire year before investing into a company like this. But overall, here would be my ranking. I would say that the ASTS stock is very, very risky, and I'm not comfortable taking on that much risk by investing into the company before they actually prove themselves. But that is not to say that this is a bad company. Clearly, like I said earlier, their IP, which is their intellectual property, is absolutely amazing. However, I'm not fully convinced as of yet. I really need to wait and see what happens to this company in the long term. So this is clearly the most aggressive and risky stock out of these three. The next company I would say is VALE. This company is not supposed to bring you or cause you to appreciate in its stock price aggressively or build wealth over the long term. It's more of a market leader that's already had a lot of growth, which is a giant company that is made to retain your current portfolio in times of stock market uncertainty. At least that's how I am using it. So this has substantially less risk than all of the companies mentioned on this list. However, it clearly has less upside because of the risk to reward ratio. Now, when we talk about SoFi Technologies, this is a very risky company. However, I like the prospects and the fundamentals of this company over the long term, which is why I have around a 4% allocation to it. But I would love to hear your thoughts down below. Remember to go and smash that like button for more videos like this one. Don't forget to comment companies you want me to analyze and review. Subscribe if you are new, and I will see you in the next YT video.